In the last chapter, we introduced the idea that as long as you're invested properly, there's nothing that the markets can do that will lead to our demise as investors. If you're investing and markets drop, the best thing you can do is to continue to invest. The longer we invest for, the better our results become, and the less risk we actually face. So far in this course, we've identified a few really important keys as investors. Our goal isn't to earn the highest return in any given year. Compounding doesn't happen over a year, but instead happens over decades and decades. Because of this, our primary goal as investors is to invest for as long as possible. We've seen that not only do historical returns become better the longer we invest for, but if we're earning a consistent return, the dollar gained in each year gets bigger. Since compounding interest works harder with each passing year, instead of taking on additional risk to make our portfolios thrive in a given year, we want to design our portfolios to survive anything that comes our way. Here's a chart showing the growth starting from zero while contributing $500 per month and earning an annual rate of return of 8% for 40 years. Similar to other charts we've looked at throughout this course, we see slow and steady growth in the beginning, but that slow and steady growth is replaced with exponential growth. In this example, we grow $240,000 of contributions into over $1.7 million. To highlight this growth, let's take a look at this data from another angle. Instead of looking at total growth, let's look at the number of months to hit each $100,000 milestone. In order to accumulate our first $100,000, it takes almost 128 months, or over 10 and a half years. But to go from $100,000 to $200,000 takes just over 5.5 years. Near the end of our compounding curve, each of the last 5 $100,000 milestones are all hit in less than 12 months. The crazy thing is that we're not changing our effort, contributions, or investments. All we're doing is putting our money in a position where it can work for us and letting it do so. Simply put, the longer that we invest for, the better our results become. That's why we want to invest for as long as possible. In order to build wealth, we don't have to take on an incredible amount of risk, risking what we have and need for what we don't. We simply need to do the right things for a very long period of time. One of those right things is diversification. Diversification in itself is a simple idea. It's that there are safety in numbers. Instead of betting everything that we have on one thing to make it big, we can spread out our risk by investing in many different companies. If you've heard the saying, don't put all of your eggs in one basket, diversification is exactly that. This is important because the more diversified our investments are, the lower our overall portfolio risk becomes. Remember, we can never avoid market risk, but we can reduce our unnecessary risk above that. And this should put us in a better position to invest for as long as possible. If we only invest in one company, our entire financial future will depend on that company's success. And even if we believe the company is unstoppable, big companies can go bankrupt, or at least can lose a significant amount of their value. An easy example to think of is Sears, which was once the world's largest retailer, with 700 stores in the US alone. Today, there's only 8 stores remaining. Or what about BlackBerry? Back in 2009, before the iPhone took off, BlackBerry's made up around 50% of the global market share of smartphones. But only 4 years later, it hovered in single digits, until its total collapse in 2022. Today, BlackBerry no longer makes smartphones, instead focusing on security software, and has lost over 95% of its value from the peak. No matter how much we believe in a company or how well it performs, we never want to be solely dependent on it, because we don't know what can happen in the future. Sears and BlackBerry were at one point the Apple and Amazon of their day. Just as it's impossible to imagine a world without Apple and Amazon, it would have been just as impossible to imagine a world without Sears and BlackBerry only a few decades ago. If you had invested $1 million in BlackBerry in 2008 at its peak, you would have around $50,000 today. Over the same period of time, if your $1 million had been invested in the S&P 500, you'd have around $3.5 million today. When we're thinking about taking on increased risk, we have to ask ourselves if it's worth it. Does a higher than expected return in a single year make all of our goals within reach? Does it significantly change our financial situation? Or if everything works out, would we be in the exact same situation we are now, just with more money? If we're able to think about this and consider the other end of the spectrum, losing 95% of our investment could drastically impact our financial situation for the worse, likely putting ourselves in a position where it's impossible to make up the difference. Even if we're able to get back to the dollar amount we were at, we would have lost years of compounding. We might feel like we've got back to where we were, but we're likely still multiples behind. Diversification can simplify our investing approach because no one knows who the winners and losers of the stock market are going to be. Instead of trying to figure out who we think it will be and placing a bet that we are right, we can simply own it all. Instead of only betting on one horse to win the race, we can bet on all of them. This way we hold the winners and the losers, but we know that the winners will outweigh the losers in the long term. This is really important because we have to acknowledge that most companies are actually bad investments. A study from 2016 by the Harvard Business Review found that 80% of companies that existed before 1980 no longer exist. Our world is constantly changing, and I'd guess that the rate of change will only increase moving forward. Even strong companies like Sears and BlackBerry can fall out of favor. A study by J.P. Morgan found that between 1980 and 2014, 40% of companies listed on the Russell 3000 experienced a catastrophic loss, which is a decline of at least 70% from its peak value with minimal recovery. For context, the Russell 3000 follows the 3,000 largest U.S. publicly traded companies. If we're looking at the risk versus reward factor, only about 7% of companies were classified as extreme winners. They also looked at what percentage of hypothetical concentrated investors would have benefited from diversification, which ended up being 74% across the board. Overwhelmingly, the study showed that investors are better off investing across the market in a diversified approach rather than betting on any particular company to take off. The risk is significant. When looking at the ratio of catastrophic loss to extreme winners, it's nearly 6-1. This hasn't just been the case for the past. It's also the case for the present. The S&P 500 is comprised of the 500 largest U.S. publicly traded companies. Currently, the top 7 companies are referred to as the Magnificent Seven, which are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These 7 companies make up 1.4% of the total companies listed in the S&P 500, but 33% of the total weighting, meaning that if you buy one share of an ETF that tracks the S&P 500, 33% of that share is invested in those 7 companies. Here's the returns the S&P 500 had in 2023 and 2024, with and without the Magnificent Seven. Although they only make up 1.4% of the companies listed, and 33% of the index weighting, they accounted for 83% of the gains in 2023 and 73% of the gains in 2024. The rest of the 493 companies had returns that more closely resembled those we'd expect from bonds than stocks over a long period of time. This information shows us the same thing as a previous JP Morgan study. Most companies don't do much, and in fact, a lot of them perform miserably. But if we invest in a diversified way, holding the winners and the losers, we can still get incredible returns. Because we only need a handful of winners in any given year to bring our returns to the next level. The tricky part is that we have no idea what the companies will be. It's the idea of the 80-20 rule, that 80% of our results come from 20% of our effort, and the remaining 20% of our results requires the remaining 80% of our effort. In our day-to-day, we might relate this to learning something new. We can often quickly pick up a lot of the important details of something new, but there is a big difference between having general knowledge and being an expert. Over the past couple of years, Nvidia has been the darling of the S&P 500, seeing unbelievable growth with the advancements in artificial intelligence. Before it started making headlines, I had never heard of Nvidia, and if you're in the same boat, you may have thought it was a newer company. But Nvidia was founded in 1993 and has been included in the S&P 500 index since the end of 2001. From the outside, it seems like an overnight success story, although in reality, it's anything but. It's been more than 30 plus years of hard work. If you've been a diversified investor, you've likely been investing in NVIDIA from your beginning. So when the stock started taking off and people were talking about investing in it, you could have taken them by surprise by saying that you were already investing in it. By investing in a diversified way, we don't have to know what the next big company to invest in will be. Chances are we already own it. We never have to try to be the smartest or best or most successful investor in a single year. Our success should be measured over decades, which requires us to be able to invest over decades. Most people think of investing from the perspective of trying to manage returns, but in reality, what we want to do is manage risk. We want to minimize risk while maximizing returns, in that order. We want our portfolios to survive for as long as possible, and that depends on our ability to invest in a way that gives us the best chance to survive the test of time. Since we don't know specifically what the winners will be, diversification allows us to invest in everything. Financial planner, author of Making Money Simple, and host of the Long-Term Investor podcast, Peter Lazaroff said, "That's really how diversification works. You are just giving up the highest highs to avoid the lowest lows." This is part of the reason why selection plays such an insignificant positive role to our long-term performance as investors. More likely than not, selecting specific companies to invest in will cause more harm than good. And this isn't just a forward-looking opinion. We've seen centuries of market bubbles in this course to support this thinking. Whether it's professionals or individual investors, we're more likely to trail our benchmark or the market as a whole. That in more cases than not, our goal of trying to beat the market actually ensures that we fall behind it. Focusing on individual companies to invest in can increase our risk and put us in a position of being one negative headline away from a huge loss. Being too conservative or not investing at all can create a desire to make up for that time by taking big bets, which often reaches the opposite goal that we're trying to achieve. By chasing returns or individual companies to invest in, you're betting that you know more or know better than hundreds of millions of investors around the world, both individuals and professionals. No offense, but the chances you know more than the rest of the world does is pretty unlikely, and I include myself in that. The long-term performance that's attributed to selection is so small because at best, it's about negligible, and at worst, our attempt to add value through selection leads to our ruin through taking unnecessary and uncalculated risk. It's much more important to focus on things that we can control, like investing in a diversified way, prioritizing asset allocation, and making long-term decisions. When we invest to manage risk instead of invest to manage returns, it allows us to work towards our goals in a stress-free way. Our investments can truly be out of sight and out of mind, and still be doing exactly what we need them to do. Even being a financial planner, I can think of a million things I'd rather do than subject myself to news headlines 24/7 while trying to beat the market. If money is a tool that we can use to get the most out of life, and investing helps makes it all possible, then it all has to work together to make it a sustainable and even enjoyable experience. Remember, our goal as investors is to invest for as long as possible. It's really just that simple. And that fact has to be reflected in the approach we take as investors.